You swipe your credit card for $100 and you feel absolutely nothing. No physical loss. No money leaving your hand. Just a soft beep. Approved. That tiny moment, that emotional disconnect, is where the entire system begins. Because when spending doesn't hurt, spending increases. And that is not accidental. It's behavioral engineering. For the last 10 years, I've worked inside a bank called Plumas Bank. I've seen how lending decisions are made. I've seen how credit risk is calculated. I've seen how people fall into debt and how others quietly win the game. Everything I'm about to explain comes from real-world banking experience. If you want to understand how money actually works behind the scenes, subscribe, because my experience can save you years of financial mistakes. Now let's continue. Banks don't just issue credit cards. They design behavior. Decades of consumer psychology research shows that people spend more when using credit instead of cash. Why? Because the brain processes card payments differently. The pain of paying is delayed. When you hand over cash, your brain registers loss instantly. When you swipe, the consequence is abstract. Future, you will deal with it. And future, you almost always pays more. Then comes the credit limit illusion. You get approved for $10,000. Suddenly, you feel financially stronger. But that number isn't wealth, it's permission to borrow. The higher the limit, the safer large purchases feel. A $1,500 laptop doesn't seem extreme when you have thousands available. But availability is not ownership. It's structured debt capacity. Now let's talk about the real engine of the system, the minimum payment. Imagine you owe $5,000 at 24% APR. Your statement says, minimum payment due, $150. That feels manageable, responsible, so you pay it. But here's what's happening behind the curtain. At 24% APR, that balance is accumulating roughly 2% interest per month. That's about $100 in interest in the first month alone. Out of your $150 payment, maybe only $50 actually reduces the balance. The rest disappears into interest. Month after month, this continues. Most of your payment feeds interest first. Principal reduction comes second. If you only pay the minimum, you can stay in debt for years, sometimes over a decade, paying thousands more than you originally borrowed. The system doesn't trap you aggressively. It traps you quietly. Inside banking, customers are often categorized into two behavioral groups: those who pay in full every month, and those who carry balances. The second group is dramatically more profitable. Interest income is predictable. Late fees add extra revenue. The longer someone carries debt, the more valuable that account becomes. And then we layer in rewards. Cashback, travel points, sign-up bonuses. It feels like you're winning, like you're outsmarting the bank. But step back and do the math. If you're earning 2% cash back while paying 22% interest on a carried balance, the math is not in your favor. Rewards are engagement tools. The more you swipe, the more likely you eventually slip and carry a balance. Once that happens, compounding interest begins working against you. Compounding is powerful when you invest. It's brutal when you owe. Your behavior is also constantly being measured. Systems like FICO assign you a number based on how you handle debt. Payment history, credit utilization, length of credit history, new accounts. You are rewarded for using credit responsibly, but you're not rewarded for avoiding it entirely. The system is structured to keep you participating. Utilization is one of the biggest silent traps. If you have a $10,000 limit and use $8,000, that's 80% utilization. Even if you've never missed a payment, your credit score can drop significantly. High utilization signals risk. And here's the psychological twist. It usually creeps up gradually. First 20%, then 35%, then 50%. Each step feels small, until suddenly, you're near the ceiling and stuck making minimum payments. From inside the banking world, I can tell you something important. The system is built around probability. It assumes human behavior. It assumes emotional spending. It assumes that at some point, maybe during an emergency, maybe during a job transition, you will carry a balance. And when you do, the interest model activates exactly as designed. Are credit cards evil? No, they are powerful financial tools. Used correctly, They can build credit, offer fraud protection, and provide rewards. But tools are built with incentives. And the incentive of the credit card industry is clear: encourage usage, normalize debt, and profit from time. If you pay your balance in full every month, keep utilization low, automate payments, and never carry interest, you can flip the system in your favor. But that requires discipline most people underestimate. Credit cards are not designed to force you into debt. They're designed to make debt easy, comfortable, sustainable, and statistically, that's enough. If you understand the design, you control the tool. If you ignore the design, the tool controls you. And most people never question the system behind the beep.